Welcome to Me Financial, the podcast designed to inspire your financial life. Hello, everyone, and welcome to the Me Financial podcast. I am Michelle Moses, your host. I am a certified financial planner, a realtor, and a former e-commerce store owner. And today I am here with Andy Woodward. He has been on my podcast for now. This will be the third time. Welcome, Andy.
Thank you. Glad to be back.
Thank you. I always enjoy our conversations. And we are going to be talking about banking and the ways you can keep your deposits safe. Mostly we're going to be talking about the FDIC, how it came to be, and again, how you can keep your deposits safe because of what happened last year. So we're going to kind of explain what happened and the changes that the banking industry is making because of that. So as a little intro for Andy, he's on the advisory board of the Gainey Business Bank in Scottsdale, Arizona, and he's worked in banking off and on for more than 30 years. His main job is an information technology consultant, and he's worked in an array of capacities in banking and in the banking industry. Let me trip over my words a little bit more there, Andy.
No worries. You got it. You got there in the end.
I did get there in the end.
And dismount.
Yes. And here we go, right into the FDIC. I know this is riveting for a lot of people, but I do think that it's really important that we talk about this because from what I was reading yesterday, 47% of deposits in banks are uninsured. And to me, that is a huge red flag. And I understand that some of it is uninsured for reasons because it's a transactional account. You know, money's going in and out a lot on a daily basis. But I do think that this is a very important topic because if there's that many people that have uninsured deposits, they need to know how to get themselves insured.
Yeah. Well, the other thing is you got to look a little bit deeper into that number. For example, during the issues with Silicon Valley Bank, which leads to a lot of this discussion. There were companies like Roku, for example, that had $487 million in Silicon Valley Bank, of which approximately $250,000 was insured under conventional insurance.
Right.
So numbers like that can really skew the uninsured deposit numbers.
And that's what I was reading about was that 90% of their deposits were uninsured.
Right.
And the issue became that it was concentrated in one industry. And because it was concentrated in one industry, and so that's kind of what they're looking at now is, you know, how much do you have uninsured? Because banks kind of depend on having uninsured deposits. And then why, and then making sure that it's not in one industry. So I found that very, very interesting.
Yeah. Just a little background in banks and the FDIC is the FDIC doesn't just insure banks. In order for a bank to become a chartered bank, the FDIC needs to approve their overall plan, including the plan for how they want to diversify their portfolio and lending, whether they have 50% in real estate, 25% in capital and improvements, and then, a myriad of other loans. That actually needs to be approved by the FDIC, and they actually monitor this on a quarterly basis.
And so when bank sets out and when they're actually chartered, I mean, they have goals for different industries that they're targeting, Absolutely. I guess. Okay.
In Arizona, for example, you can't really expect to be an effective bank without having a portion of your lending going towards real estate, whether it's commercial or residential. It's just we're such a real estate-driven economy here, where in Silicon Valley, where Silicon Valley Bank predominantly worked, you can't be there without having a significant percentage of your investments in technology. But it's that overall portfolio mix that the FDIC looks at when they're assessing risk in the
because that'll keep bank. You safe and keep the runoff, which is exactly what I just mentioned. Yeah,
exactly. Yeah. But at the end of the day, the FDIC wants to make sure that they're not going to be in the hole for a significant amount. They're an insurance company. They want to make sure that they're not going to be responsible for a significant amount of losses. And the way to do that is to stay on top of it in the first place.
Yeah. And they even go in and do like tours of the bank. I mean, they go in and they do inspections.
They regularly are audited. And that was the other interesting thing about like Silicon Valley Bank. It was the FDIC that made the decision with them, as well as Signature Bank and the other banks in trouble at the same time. They're the ones that decided, nope, you're no longer a bank, and pulled their charter, and then actually did the plan for cleaning up the assets and moving them over to other more healthy financial institutions.
Yeah, because they were so concentrated in one industry and they had such a high percentage of uninsured deposits.
Well, not only that, I think one of the big issues with Silicon Valley Bank was what's called mark-to-market of their bonds. They had a significant number of long-term bonds, and those bonds were at about 2.5%, and they were 2 and 10-year bonds that they had intended to actually wait until those bonds had matured. So they were what's called hold to maturity. And what happened is then
interest rates
go to 5% on the 10-year instead of 2.5%, and then in what's called mark to market. So oversimplification here, with a bond, let's say a 10-year bond at 2.5% for $1,000, you're actually seeing the discount on that, which is $780 when it's 2.5%. Well, that same bond, when interest rates went to 5%, if you remember, there was an inverse relationship between the value of the bond and interest rates. So as interest rates go up, the value of the bond goes down. So that same bond went from $780 down to $610. So you're talking a 20% drop in their assets. And then at the same time, people looking around going, hey,
I could get more over
I've
here.
got other banks that are willing to pay 4%. I'm going to withdraw my money and move it over to another institution.
Yeah, and that was another thing that the banking institute that I was that I've been reading about for the in preparation for this was the high that people can just move money so quickly between banks, and how much that's affecting the banking industry. So it's just really interesting of how they're kind of changing. But let's back up a little bit with the FDIC and what you were saying about getting the charter. So could a bank be a bank without the FDIC?
No. I mean, there's credit unions.
Right, but they have their own insurance.
Right, and brokerage firms have their own insurance, and they're very similar in the coverages that they have, but you pretty much need to fall into one of those 3 lanes. There's no other lane. Getting a bank without it.
And the FDIC came about, after the stock market crash in 1929, and it was created in 1933, I believe, somewhere around in there. And it was really interesting fact that no bank has been, I guess nobody has, there has always been insured, and all banks have been saved since then. So it really does work.
Well, nobody's... they've had a 100% payout on insured deposits since they started in 1933. One thing I couldn't find was how much was lost in uninsured deposits in that time frame.
I can imagine it's millions, but
I don't know. I don't know. Even in the case of Silicon Valley Bank, they actually managed to pull that all together and get it all parted out so that nobody lost any money, insured or otherwise.
Right. And then to replenish the fund, they are basically creating an assessment for the banks that benefited the most from the bank splitting up. And then they replenish the insurance fund through that, in case everybody was wanting to know.
Well, I mean, it's like any other insurance. Banks have to pay a premium in order to have that insurance across the deposit accounts. And that's assessed based upon, the deposits and things like that. And like you said, some banks actually got a pretty sweet deal out of
they really did.
Getting clean deposits from
from an insurance
parting out of
and it's
banks.
Guaranteed by the government. I mean, it's kind of like buying treasuries at 5.4% right now, or they're not that today, but it's kind of a sweet deal. So okay. So back to the FDIC. So you are very interested that the FDIC does more than just this insurance. So do you want to touch upon that too?
They actually, because they do insure the banks, they're the ones that decide whether or not the bank gets to be a bank. And then throughout the life cycle of it, banks have to report on a quarterly basis. And actually, if you want to look up these things, there's an organization called the Federal Financial Institution Examination Council.
It sounds very government-y.
FFIEC.
Yes.
All these things are very exciting. And you can actually pull what are called call reports on each individual bank. They're publicly accessible.
How long does it take a bank to become a bank?
In the case of Gainey, it was almost 2 years.
Really?
A lot of it. There's at least a year worth of regulation. New banks aren't really formed all that often anymore.
It's all about acquiring.
It used to be they were formed all the time, and I forget what the number is in Arizona. We have actually a pretty small number of banks here, considering the size of the population. I believe at the time we started on Gainey, there were 16 community banks in the state. And, to put it in perspective.
Yeah, that's not very many.
There's about 40 in Utah.
Yeah.
But there were only, in 2023 and 2022, when we got our charter, there were only about 20 banks formed that year across the entire country.
And so why does it take so long? Do you have to raise a certain amount of money before and does it have to be, what am I trying to say? Like across industries, like what they were talking about? So you've got to have like a small portion of...
It has to be diverse.
Yeah.
So you need a minimum of $15 million, and they discourage anybody from owning more than 9.9% of the bank.
Okay.
So that $15 million needs to be distributed across 11 or more people, minimum. And then if you're above 10% ownership, you actually need to be vetted by the FDIC. And you'd be surprised, like even going through board member approval for the actual legal board. I'm on the advisory board, but for the legal board, they turn down anybody that's had a short sale and things like that.
Oh, yeah, I could imagine that. Yeah.
And they
want responsible people.
Right. They actually really look closely at this. So that's the reason why, they discourage ownership beyond 9.9%. And so they're, even going through this process, there were a lot of people going, $15 million, that's no big deal. I'll just write you a check right now. And no, the FDIC doesn't like that. They want it to come from multiple people. They want you to build your business like you would build a business. Right.
I mean, that makes more sense than being dependent on one person.
Right. But they also have to approve the lending plan. So what percentage of the deposits are going to be lent out and what the ratio is as far as where that goes.
Wow. Okay.
And going through the approval for Gainey Business Bank, they didn't really, they actually, because there's so few banks going through the process right now, they were very involved. So they make sure that everything's lined up to start with, even before going through the
process of it. Okay.
And it really does take quite a while.
So you're basically kind of applying to raise money, and then there's a whole process of while you're raising the money, and then you actually get the charter for the bank.
So the money the investment money initially goes into escrow. Mm-hmm. So once you get over that $15 million, then you can apply to break escrow, in which case you can then start signing leases.
It's like buying a property or something.
So you can then sign leases on
a building
and things like that, and hire people and what have you.
Okay. And so I assume that this costs a lot of money to do this. Like, are you paying the FDIC fees as you're going along in this?
I don't know what the fees are. I wasn't involved on that.
I'd be interested in knowing that.
But
okay.
I would assume that is the case.
Uh-huh.
It's probably about $1.5 million in order to get set up as a bank, because there's a lot of things that actually need
you got to pay a lot of lawyers to write a lot of things up, and I mean it's kind of like starting any other business or a fund, an alternative asset fund or something. It just takes a lot of cash to get going. Okay, well are you okay if we shift gears a little bit, because I want to shift gears on how to keep your deposits safe, because I've gotten this question, especially from the older crowd, people that downsize, they start to have a lot of cash, they're going into retirement and they want to make sure. And I want to talk about, there is a tool online, you guys, and it's called EDIE, EDIE, the Electronic Deposit Insurance Estimator. We're going to be full of all of these little
Yeah, they're
very,
fun, aren't they?
very, very interesting and riveting, what do you call those?
Acronyms?
Acronyms, yes. So it's EDIE, EDIE.FDIC.gov. And if you go on there, it's a really simple tool. You can just type in whether you've got an IRA or a trust. And I think we need to touch on that too. We'll touch on how when you have a trust, you can get more than the $250,000 of insurance. So I think most of us know that with banking, when you have a deposit, when you have an account, you are insured up to $250,000 for each of the owners of the account. So if you've got a joint account with two people on it, you would be insured up to $500,000 for that account. And so that's what we're talking about when we say insured deposits or uninsured deposits. When you're up over and you're at 501, that $1,000 is not insured, but your $500,000 in that joint account would be insured. So I think it's really important that you know this on your, when you're going to bank, which amount is insured, because if something does happen, it happens quick.
Yeah.
And so you're not going to have time to be moving all of your stuff around.
And what you're talking about there is what's referred to, another exciting term, separate capacity. So what you have in FDIC insurance, and this applies to credit unions and brokerage accounts under the SIPC as well, they all pretty much have uniformity on this. Separate capacity includes things like single accounts, joint accounts that you mentioned, whether it's a retirement account, a trust account, a business account. Each one of those separate capacities have their own coverages.
Right. And I think to simplify it, we could say just separate accounts or separate people almost.
It's not really separate accounts. It used to be that, and it was really a misunderstanding, because it's not the case, that somebody would just go ahead and say, well, if I've got $1 million, I'll just open 4 separate accounts. But that's not the case. If they're 4 separate single accounts, you're only covered for $250,000 total. But if you, for example, have an individual account and then you have a joint account with your husband, that's $750,000.
Right. And then if I had a trust,
right, then that's $1 million.
Yeah.
Same thing with a billion, or not a billion, a business account.
Yeah.
Mix those two.
No, that's
together.
okay. But if it's an LLC, because when I was doing it, I did my LLC and it was just for $250,000.
Right.
Yeah.
Because that's considered one entity.
It's one
not
entity.
The owners
yeah.
of it.
So let's get into the trust too, because the trust is really interesting. So they actually just changed this law, and you can actually go up to 5 beneficiaries now, which is $1,250,000. And this is based upon the beneficiaries of the revocable or the irrevocable trust. So if you go to the bank and you and if you have a trust, you basically need to make sure that all of your checking accounts are in the name of that trust in order for you to quote unquote fund the trust. And that is then your insurance is based upon the beneficiaries that you have. And so I think that's where it might get a little fishy, and you want to make sure that you're covered. But it is a way to get more insurance rather than $250,000. The other way to get more insurance, and I thought this was really interesting, is that some banks will offer, like if they've got a huge deposit. So let's say you've got a $2 million deposit and that bank really wants your deposit. Banks will get together and they will jointly insure it. So it's almost like you can have your account in the one bank, but then it is spread, your insurance is spread across different banks.
Yeah, like Wintrust has a product called MaxSafe where they can spread it across 15 community banks. There's a handful of products out there now
that do that.
Right.
And I hadn't seen a whole lot of it, but I'm not in the banking industry, so
no. There's another thing called CDARS, CDARS. I forget what the acronym stands for, but it's a similar situation for certificate of deposits that allows I think this is primarily the bigger institutions where they're able to spread the certificate of deposit load across multiple banks as well.
Yeah. So, and I know not all banks would offer that, but there are organizations that they can join to where you could, so that you're not having to go from bank to bank to bank and have all of these, because we all know how fun that is. To have all that paperwork and all those logins, that you could have your money in one bank account and then get the insurance from multiple different institutions.
Yeah.
Yeah. So there are solutions out there. I just think that you just need to be aware so that you're not, caught. I mean, because you could technically, if we had a lot of bank failures, I could definitely see where people wouldn't be as lucky as what happened with Silicon Valley.
That is the point of the FDIC. And one of the reasons why this is so boring is because our banking system is considered safe and secure. And it's largely because of the FDIC and their actual policies. It's one of those things that you can sleep at night knowing that your deposits are safe.
Right.
It's put into place in order to avoid runs on the bank where everybody thinks, oh, I'm going to lose their money, which happened during the Depression. So they pull their money out, keep it in their mattress instead.
Right. Versus now we have insurance and everybody pays into that.
Right. It's the actual reliability of the banking system itself. And it's one of those things it's pretty rare globally in that how well it works. And it's got a long track record of success, almost 100 years.
I know. It is a really long time. So there was another thing I want to ask you about that I found really interesting was that the banks, the Federal Reserve's discount window. So when deposits outflows exceed, I guess, their reasonable expectations, they were trying to avoid banks tightening credit because we all know that sends everybody into a panic when we tighten credit. Do you know anything about this Federal Reserve discount window? Because it seems like a lot of banks are not prepared to use it.
No, it's like every bank has to participate. It's actually a requirement of being a bank. And basically what it is it's a short-term lending capacity between, or lending facility between banks. And what it's intended to do is that banks hold, so extra deposits that aren't lent out are typically held in U.S. Treasuries. So those banks can then put the U.S. Treasuries as collateral to the repo window and then actually borrow against cash deposits that are available, and they're going to have to pay the market rate. So
what is the repo window? I know. I'm asking, how do you explain all this?
I know you and I have talked about it
yes.
Extensively in the past, and it's
very
kind of
convoluted. Yeah, it really is.
But it's
banking has this whole other market in the background called the repo market.
It's not really a repo in the typical sense of repossession or anything like that. It's basically allows for banks that are short on cash to be able to put up collateral and borrow cash against other banks. So when the Federal Reserve is setting interest rates, the only rate they're setting is the repo window rate. So
that's how much a bank could borrow, a bank can borrow at.
From other banks.
Right.
So it's the interbank lending rate is what it is. So it allows banks, if they need cash, if they're short on cash, to go to the repo window, pay the Fed rate in order to borrow that cash. It's really what it's for.
Right. And what I'm reading is that a lot of banks are not prepared to, automatically tighten credit rather than go to the repo market, basically, to go borrow more money.
Well, again, it's a short-term facility. It's not really...
It's just overnight.
It's not really intended to be one of these long-term... It's like, I want to lend out money, so I'm going to borrow it from the repo window. It's a very volatile thing. And the interest rates, even though the Fed sets the interbank lending rate, some of those repo window rates, like if there's a shortage of cash and everybody's being really tight with it, some of the interest rates in the repo window have spiked to 16%.
Which is why we've seen the government infuse cash into it. Why do you think that's happening? I know we're totally getting off topic of keeping your deposits safe, but why do we think that this is happening? Because this has been happening for like 5 years now that they've had to deposit money into it.
It's usually a liquidity crisis.
Right. And that's another thing I was reading is that deposits are becoming less and less.
Right. Well,
for banks.
but the thing is deposits are essentially what allow a bank to lend.
Right.
So if a bank doesn't have deposits, what are they actually able to lend on?
Right.
Is the issue.
And people are just not keeping their money in banks, and they're just putting it to work. Because I think we get, especially in a low interest rate environment, what happens is people want to take more and more risk. They have more appetite for risk because they want to make more, and it's harder to make more. And so then you're pushing yourself, and you take a lot more.
Well, ever since prior to 2008, the great financial crisis, there was always an opportunity for depositors in regular savings account to make more than the inflation rate. So when interest rates went to zero, even with inflation at 2%, you still weren't able to keep up with inflation by having money stored in the bank. So because of that, the intention was to keep people from holding on to their money and take more risks and get it out in the economy versus sitting on it. Until we return to a situation where savings accounts will keep up with and stay ahead of inflation. We really need to return to that situation in order for banks to be
right. And this is why inflation, and inflation is so important.
Right.
Yeah.
But also interest rates allowing depositors to actually stay ahead of.
Right. And stay ahead of the rate of inflation.
Right.
Yeah.
So
I know it's a very complicated world, guys. I mean, it all goes together.
Yeah. And it's been unfortunate, but the 15 years of zero interest rates, really kind of was detrimental to the depositors and people that actually hold money for safety reasons.
Right. Yeah. And just for the rainy day funds. Yeah. I mean,
right.
I think that's the way we can think about it, is that you're holding money for a rainy day fund just in case something happens. And by us having interest rates at zero, we're all out there, trying to get a return on something where it's not in the bank. And so that's where we're trying to kind of return to.
And as you mentioned earlier, because we have all these electronic mechanisms for being able to easily move funds between bank accounts, banks need to be a lot more competitive on the deposits.
Right.
So they need to pay a market interest rate. So the old school arbitrage of being able to pay people 0.1% and then lend them money even to bonds at 2.5%.
Yeah, the playing field is getting more even
right
now with the information. So information is traveling at the speed of light, and so their customers are able to make more, which is good, but the banking industry kind of needs to move with it.
But it's also a little bit of short-term thinking when it comes to interest rates, because the banks themselves are generally buying treasuries that are 90 days rather than buying these 10 and 30-year treasuries. So they're in a situation where, because they do need to be adaptive and competitive, the vehicles that they're using are very short term.
Right. Well, and so they're such a victim to whatever's happening with the interest rates too.
Yeah, and that's what happened with the whole mark-to-market scenario, that they couldn't pay market interest rates because they had essentially bought bonds at 2.5%.
Well, and at too long of a time period. Yeah. Okay. Is there anything else that we're missing here? I feel like we kind of covered some high points of things.
I think that's the big stuff.
Okay.
And again, it's just, we talked about the FDIC, but the National Credit Union Administration, NCUA, handles credit unions. All the
it's the same, except the credit unions don't cover CDs and money market funds, and the FDIC does cover those.
Right, but they do still have separate capacity that single and joint accounts are treated differently.
Right,
each individual across each one of the account types. So there is ways.
Yeah, it's the same kind of thing. Right. They're the same. It's the same insurance, but it's a different organization. But they don't cover the CDs and the money market. But I think they have other tools that you can cover that. And so you guys, I really think a great tool, if you are worried about your deposits, is to go to the edie.fdic.gov. It's EDIE. And you can just type in every single account that you have at a bank. And I should talk about that. We did not talk about all of your brokerage. And, if you invested in a stock, mutual fund, if you have taken your money out of cash and put it into another vehicle, it will not be covered by any of this insurance that we're talking about, because you've taken your money and you've put it into another vehicle like a stock. Then it's going up and down with the stock market. So if your stock goes to zero, then obviously you've lost all of your money. But if it goes up, then you'd make more. And so,
yeah, and the SIPC, which it handles that, they don't cover you from taking risk yourself.
Right. They only cover your cash that's in the account.
They cover the SIPC covers $250,000 in cash and $250,000 in equities. But even then, you know, we're not even getting into custody, because there were, you know, at the same time Silicon Valley Bank was having its issues. There was a lot of concern about the mark to market that Schwab had, for example. They had a lot of long-term treasuries that they intended to hold until the very end. Anyway,
it gets complicated.
Yeah. It's a little outside the scope of this discussion. One of the last things that I wanted to mention that really never comes up, but it is a consideration, and it is the claims process. So if a bank does go under to the point that they're not able to, you know, move it off to another institution, which they've successfully been able to do most of the time, especially the last 40 years, you do have to file a claim if the bank goes under, and it takes about 1 to 3 months to get your money back. But the covered deposits are 100% returned at that point.
Okay, interesting. All right, so paperwork, you'd have to fill out paperwork to do a claim. Okay.
And so it's not, you know, that's one of the reasons why the FDIC prefers to, before they get to the finish line and completely go under, we're going to pair you up with another financial institution and part it out. So there is the continuity with those accounts, so the accounts stay open. But if it does completely fail, then, you know, it's like any other bankruptcy process. You need to file a claim, but they typically take about 1 to 3 months.
And your funds would be frozen, basically, for that amount of time. Okay. All right. No, that's a great tidbit. I'm glad that you mentioned that. So you guys let us know if you have any questions or anything. I know that we covered a lot of acronyms, government acronyms that are super duper interesting, but I do think it's very important, given the amount of uninsured deposits that there are out there. Please make sure that you cover your checking accounts and savings accounts or high yield savings accounts, wherever you have your money, and make sure that you are covered and you don't have too much in there. And Andy, thank you so much for being on again. I appreciate it.
Of course. I always enjoy it.
Yeah.
I think the key is to diversify, whether it's across accounts, banks, types, you know, don't hold all your money in one spot.
Yeah. Don't put all your eggs in one basket. I just think that goes for investing. It goes for your accounts. I mean, it goes for everything, honestly.
Yep.
Yeah, just diversify. So thank you so much for listening, guys. Please let me know if you have any topics. Leave me a review, and please tell your friends. And thank you so much for listening. I really appreciate you and all your feedback and your time. So thank you.